Good morning and welcome to another Five with Fitz. I'm Keith Fitz-Gerald. Thank you for joining me. Let's get right to the markets. Not that I am surprised, and I trust you are not either. But the S&P 500 has hit another record as I record this in the early going, with traders shrugging off the U.S. government shutdown, at least for now. Now, that could obviously change, and for that matter, probably will. Do not get distracted. That's the real message here. A few weeks ago, there was something like $7.1 trillion on the sidelines, although to be fair, that's probably dropping as the markets rise because everybody's buying, and the Fed had yet to cut. The bigger issue, and the one you want to focus on today, right now, is that the shutdown could finally move Jay Powell and his band of merry marauders off the sidelines with real rate cuts. Now, that is what traders are actually betting on and why they're buying. Always remember, think like a shark, not a minnow. The bet isn't about the shutdown, but what happens when the markets move on. In other words, being one bar ahead of everybody else. Pun absolutely intended. That's why I named it that, because it's an old trader's joke. You can be one bar ahead of everybody else. You have the advantage. Anyway, here's my playbook for the day. What does the shutdown really mean for your money? That's a question that's on a lot of people's minds right now. The current administration thinks that it'll be over soon, and VP JD Vance noted, quote, "I actually don't think it's going to be that long of a shutdown." The public, on the other hand, seems to think that this is going to be a protracted closure. Now, either way, what we, as in you and I, want to focus on as investors is that the S&P 500 actually rose during most of them. Prior shutdowns, I mean. Moreover, the average return for the 3 months later after the shutdown was positive. 6 and 12 months on, it was 7.5% and I think 12.7% respectively, if memory serves. Now, a lot of people don't believe me. I get that. I mean, in fact, I get that a lot whenever I whip out numbers like this. But take a good hard look at the chart that is in the written version of the Five with Fitz today and let it sink in. This isn't a left or a right issue. It's not a Democrat or Republican issue. This is about markets and money. We don't do politics around here. We do money. And the money shows that you want to focus on it because it is what's going to move you and your wealth forward. So, Keith's investing tip in this department is very simple and very appropriate. Don't ever let politicians rent space in your head or your portfolio. The markets have a very defined upward bias over time, so be sure that your money does too. All right, number 2 today. Uncle Warren, as in Big B Buffett, has gone shopping. Now, Uncle Warren is putting some of Berkshire's record $344 billion cash to work, dropping $9.7 billion to buy Occidental Petroleum's chemical unit, OxyChem. Now, Occidental gets a cleaner balance sheet and room for buybacks. Berkshire gets another operating company. But here's the real lesson and the one you want to focus on as an investor. Despite what many folks want to believe because it's convenient or they're simply kidding themselves, Buffett is one of the most concentrated investors on earth. Instead of buying a little of this and a little of that, Uncle B tends to put massive bets into companies he understands. In this case, a cousin to something he already owns. Now, Wall Street loves to sell you on diversification because it keeps you spread across dozens of fee-generating products that help transfer your money into their pockets. It worked for a long time, but the markets have changed, which means you've got to think about the world differently if you want different and presumably better results. Now, many investors try to copy Buffett by buying whatever Berkshire discloses in its 13Fs and other filings, but that totally misses the point. And it sets up the average investor who does that for a rough ride. You don't win by blindly mimicking. You win by consistently buying the best and ignoring the rest. By the way, and in case you're wondering, no, I don't own Occidental because my concentration is to prefer another concentrated choice that has outperformed Occidental over the last 1 and 3 years, has a stronger balance sheet, better management, and best of all, a 6.84% true shareholder yield. That's a key metric in my analysis, which is why I prefer it. Occidental's true shareholder yield is negative 4.86. So I think there's an argument to be made. Anyway, hopefully you have similar choices in your own portfolio or you're thinking about them seriously, right? If not, do something about it. People worry constantly that the train has left the station, but what they often fail to realize in situations like this is that there are plenty of trains leaving the station from an investing standpoint. As always, I'll be here if you'd like some help, and people from all over the world tell me that one bar ahead has helped them do just that by becoming better, more consistent, and considerably calmer investors. And that, my friends, is humbling as heck. So, anyway, that's enough about that. Number 3 today, go with the originals, not the copycat. Amazon has just rolled out a new bargain grocery line it's calling, ta-da, Amazon Grocery, with more than 1,000 items, mostly under $5. All right, I get it, but yawn. Costco nailed this decades ago with Kirkland, which has become the gold standard in private labeled everything. Walmart's got great value, Sam Club has members mark, Target's got good and gather. I mean, you get the idea, right? So Amazon's new play, I mean, really, it is pure copycat. It's another Me Too moment from a long storied company that's once again trying to prove it can compete in the food aisle without tripping over itself. Meanwhile, grocery stocks like Albertsons, Walmart, Kroger, Costco, and Target all dipped on the news, which, does tell me that the market still takes Amazon seriously, even when it's late to the party. So there is that. But Keith's investing tip in this department is very appropriate and very simple. You never confuse the copycats with competitive advantage. Costco prints money with Kirkland because shoppers trust it and buy in bulk. Amazon's late move may grab headlines, but if you want real staying power in your portfolio, it's almost always a better to bet to go with the player who created the game, not the one playing catch up. And it doesn't matter what industry we're talking about. Number 4 today, I could only grin ear to ear. Tesla, the numbers are out and they're not what the haters ordered. Pun absolutely intended. Get it? Orders, haters ordered it. Yeah. Anyway, I haven't had enough coffee today. But once again, Tesla has put up the numbers while the haters drop excuses. Tesla just crushed its Q3 expectations with 497,000 deliveries, up 7% year over year. Wall Street was looking for 447,000. So that's a pretty big, overage there. Betting against Elon Musk today would be like betting against Steve Jobs back in the day, something you've heard me say more than once and very few people still understand. But take that seriously. And here's why I say that, because the investing tip in this department is simple. Wannabes often focus on being right, but the world's most successful investors focus on being profitable, even if they're wrong. So here's what you want to do, right? Take a hard look in the mirror and figure out who you really are. Now, it's okay to be either, right? You can be an investor, you can be a speculator, whatever you want to do. But the answer could surprise you. Are you more interested in being right, or are you more interested in being profitable? All right, speaking of profits, number 5, private funding's new profit potential. This is a very, very interesting development. Chances are good that you know what a pain in the you-know-what it is to borrow money from conventional banks. Companies do too. The private debt market is much healthier, particularly when it comes to asset-based financing. Now, asset-backed, asset-based. Now, if you're not sure what that is, and I don't blame you if you're not, here's a quick primer. Asset-based financing is a type of lending where companies borrow money or individuals borrow money using their assets, like inventory, accounts receivable, equipment, houses, cars, I mean, you name it. But the reason I'm bringing this up is that there's a big split, something you've heard me talk about numerous times on television and at presentations around the world over the past 12 months. And let me explain what I'm talking about here. Conventional banks are in real trouble when it comes to lending because it's antiquated process, it takes too long, they can't check enough boxes, they are always asking for yet another form, yet another data point. It has nothing to do with your credit whatsoever. It's all about them packaging the loans up for Wall Street. But private asset-backed markets are in fact rocking, and they're rocking in nearly every category. Residential mortgages, consumer loans, student loans, auto loans, etc. In fact, CNBC is reporting this morning, which just again made me grin ear to ear because we were ahead of this. PIMCO is highlighting the same thing I'm telling you about today. Again, having originally put my thinking and a specific research recommendation on the map with the OBA family more than 3 years ago when I saw the push to private credit is likely. Now, it makes absolute sense. So now, as a result, I'm thinking about adding to it aggressively given what's happening and what happens with choices made using Keith's rule of the back page when that stuff becomes front page news. Perhaps even a new choice, too, if what's happening accelerates like I think it might. So, something to think about. Anyway, Keith's investing tip today. Many investors limit their choices because they want to diversify. So they buy a little of that, a little of that. But Uncle Buffett concentrates. And he does that with another name or another offshoot that can be dramatically more profitable if you can get it right. So you want to think about doing the same thing, especially if there's an income component, as is often the case with lending related instruments and investments like the one I'm talking about here. Today's bottom line: skipping a workout feels harmless until it becomes a habit. It is absolutely the same with skipping your investments. Success does not care about excuses. As always, let's make it a great day. Thank you for watching. You got this, I promise. And tomorrow it's Friday, and the new One Bar Ahead October issue drops as well. So I'm going to get back to that. You get back to having a great day, and I'll see you tomorrow. Thanks for watching.